All right, let's get started. I'm offering today to anybody who wants it a free used water bottle. Okay, looks like a nice one, and a hair, whatever you call this thing. Okay, I'm gonna put them together. If anybody would like it, you can sneak back in here after class is over with when nobody sees you, and you can grab it and take it home with you. Okay, I'm sure if you steam it or whatever, it's just fine. All right, so we have finished 3 of the 4 chapters that we're going to cover before your first test. We will finish the 4th chapter today. There's actually not a lot in chapter 4 because a lot of it's cut out, which I'll explain why in just a minute. We will have 1 day of reviewing for the test, and if you take a look at Canvas, you will see, so if you go to your Canvas homepage, you will see down here under test material, there'll be some practice problems, some practice questions for the test, which we can talk about those when we review for the test, the solutions to the practice questions, and then a study guide and a formula sheet for the first test. So all of this 1, 2, 3, 4, 5, 6 items here are related to getting you ready for test 1. And again, we'll cover that. Typically, the class before the test. So whenever you decide to have the test, or we can do it however you want to. Okay, I'm just here. I'll let you vote on how you want to do the test, how you want to do the review. Doesn't matter to me. I'm flexible. I'll do whatever you want. Also, wanted to remind you that today at 2 o'clock, your first quiz will open. It's going to be open from 2 o'clock today until midnight on Saturday. So you've got essentially Thursday, Friday, and Saturday to take a 30-minute quiz. The quiz covers just chapter 3. Okay, so there's some ratio calculations, there's some definitions, there's some theory questions. It's just a good prep for the test. Of course, with the quiz, you're going to take it on Canvas, so you have access to your books, your notes, the slides, whatever. Of course, in class, when you take the test, you won't, but again, it still gives you good practice looking at these types of questions. Also, the practice questions listed under the testing material, those are pulled from the same test bank that your test questions come from. So I'll just do that so that you can have some practice, just kind of reading the questions. Some questions are just written a little differently, and so I want you to get kind of get familiar with that. Now, if you're listening to this in the online class, I'm hoping to have your quiz, number 1, up and ready by 2 o'clock. If not, it may be just a little bit later, okay? But it will be up and ready this afternoon. And as you'll see, as we get closer and take other quizzes, I will change the dates here to correspond to when we're taking quizzes. I will tell you, quiz 2 and quiz 3, these are both related to chapter 5, which is going to be the time value of money chapter. That'll be the once we finish with this test material, that's going to be the most important chapter we cover all semester. And that's when we get into what I call real finance. Okay, so your financial calculators and talking about investing and all of that, that's going to be chapter 5. Quiz 4 is related to chapter 6, I think, and quiz 5 is related to chapter 7. So again, we kind of jump around here, but the quizzes should be pretty easy. You get to take each quiz 3 times, and your highest score counts. All right, so that has brought you up to date. What else? Are there any other comments or questions about the class, the test? Let's go ahead and discuss a possible test date. Now, like I said, we will finish chapter 4 today. We're going to review for 1 day, so that would be at the earliest on Tuesday. So that means that the earliest that you could take your test would be, at least theoretically, 1 week from today, so next Thursday. if you want to push it back until the following, now when is 1 week from today, by the way? The 16th? Okay. So the 16th, if you wanted to push it back to the 21st, I think, which is the following Tuesday, that's fine. I mean, you can even push it back to the following, actually you can't. We're not going to have class that day. Okay, we're not going to have class, at least right now, the way things are set. Now, it could change, but right now, I'm scheduled to be out of town on the 23rd. Now, don't hold me to that. That can change, but again, I'm scheduled to be out of town. So, it looks like next Thursday, the following Tuesday are potential options. I don't want to get too far out because then we start new material. We're covering that. Then you have to kind of shift back and forth, and I think that's a little bit confusing. But are there, and again, there's a lot of people who decided not to come today because it's cold, which is good for you because you get to vote when you want to have the test, and they don't. Now, if some of you have a certain, let's say next Thursday, you've got 3 tests. You're like, oh my gosh, that's a terrible day. Let's not have it on Thursday. Then you need to motivate your classmates not to vote to have the test on that day. Because we're going to vote on it. The majority will get their choice in terms of the test. So are there any comments, any questions? You guys have gone into hibernation. You get cold for 1 day and you've gone into hibernation mode. It's going to be back in the 50s tomorrow, okay? So it'll be fine. This is just 1 day of cold weather, so you'll be okay. So, comments, questions? You're just going to let me set the test date and make it really hard and what do you want here? I need some feedback. The 21st. Okay. I will try to I'll try to work with you, especially if it's a really good reason, okay?
If we have it on like the 21st, that Tuesday, could they do that 16th?
Yeah, that's what a lot of people say. If we're going to have the test on a certain day, for example, that Tuesday, the 21st, I'd rather review on the Thursday before that so that I don't forget the information or so it's fresh on my mind. And that's fine, okay? Like I said, I can work it any way that you want to.
But we do learn
We would probably just sort of start into it a little bit. I introduce it to you. You can be working on finding a financial calculator if you don't have one. So we can cover some useful stuff, but it's not like we'd be so deep into it that it's going to confuse you. Now, I will tell you, this spring, I'm going to be traveling quite a bit this spring. And so what I try to do is, at least if I'm going to miss a couple of days of class, I try to post at least one Tegrity video so that, you're getting your money's worth in terms of class. I know most of you would prefer it if I didn't do anything and you just had class off entirely, but the professor part of me says, yes, I need to give them at least something to watch and to learn. But I will just go ahead and warn you, I will be doing some traveling this spring due to work. All right, so let's go ahead. Any other comments on dates? Any problems? That's a good question. The answer is no. But it's good. It's a good question. Okay, it's a good idea. I've actually tried that in the past. It's hard to do. You'd think that would be easy. You have some people come in on Thursday, some people come in on Tuesday. You wouldn't believe the problems it causes. So it's a good idea. Thank you for mentioning it. But no, can't do that. All right. Now everybody else is afraid to ask a question now. I had to say no to one person, and everybody's afraid to ask a question. Any other comments, topics? What about this side of the room? You guys are just easy to get along with over here, aren't you? Okay. That's a good point. Oh, you're agreeing? Okay. All right, so let's go ahead and vote. We've got two options, and we will review the class before the quiz, whenever that is. Okay, I mean, the class before the test. So if you vote to have the test on a week from today, we'll review on Tuesday. If you vote to have the test on the 21st, we will review on whenever, 16th, Tuesday. I'm all confused now. All right, so how many people vote to have test one on Thursday the 16th? Raise your hand. All right. I'll go ahead and ask the question because some of you might be abstaining for whatever reason. I don't know. How many people vote to have the test on Tuesday the 21st? Raise your hand. All right. I just wanted to have the official count. I mean, I didn't count, but that's more than raise your hand the first time. So we will have test one on for the in-class class on Tuesday the 21st. We'll review on the 16th. That means on Tuesday, what that means for you is on Tuesday, please don't lay out on Tuesday thinking, I don't need to come to class because we're just going to talk about stuff for the next test. We're going to cover some important stuff on Tuesday, okay? So please try to be here if you can. Yes. Yes, so the review that we cover on Thursday will be posted on Integrity. So, and what I typically do is I try to work through any problems you might have. Now, again, keep in mind also at the very beginning of your course homepage, you've got some suggested questions and solutions for each chapter. So you can click on this. It'll show you from chapter 1, chapter 2, chapter 3 what homework questions I think are helpful, and then the solutions manual. So if you look at any of these and you don't understand it, I'd be happy to work through those. Now, let me give you a couple of suggestions about the test. And we'll talk more about this in the review. But the test is going to be 50 multiple choice questions. Okay, so 50 questions. They're going to be a combination of definition and theory type questions, and then some calculations, some problems. But again, they're all in multiple choice format. Typically, I mean, a lot of times when people think about finance and they think about tests, they think, wow, there's going to be a lot of calculations on the test. Well, I mean, that's not actually true. It's probably weighted about 60 to 65% definitions and theory, and about 35 to 40% calculations. And the reason I tell you that is, one, you typically ask me that, what's the breakdown of questions, but secondly, it allows you to kind of study to your strengths or your weaknesses. Because I have some people, you know, they're all definition and theory. That's all they look at. That's fine. And if you know all of that, you'll make about a 60 on the test. Some people just look at the calculations. That's all they study. And again, they may not do as well as they would have liked. So again, kind of study both types. Start as early as possible. I know they tell you this in every class, but it is especially true in this class. Don't try to sit down the Monday night before the test and spend 12 straight hours learning the first 4 chapters. You'll drive yourself crazy, okay? It's just hard to look at this material for that long. So start early, working some problems, looking through the chapters, and you've got plenty of time up until test time to prepare. And if any of you have questions, let me encourage you to come by and see me, okay? Stop by, ask some questions, we can work some problems, whatever it might be. Or even if you just have one simple question, come by and see me, okay? Let's see, I think that is, okay, I think that's it in terms of the tests for now. So again, Tuesday we'll hit chapter 5, a really, really good chapter. We'll go through some information, and then view on Thursday, test on Tuesday, and as of right now, no class on the 23rd. I think it is. All right, so is that it? You're thinking, I know when the test date is. I don't even need to stay here, okay? But let's cover chapter 4, okay? Just to make sure that you understand chapter 4. There's just a few slides here compared to the other chapters. And we get to talk about the exciting world of cash flows and financial planning. Actually, we're going to talk more about cash flows. The reason that we don't spend much time on financial planning here is, for whatever reason, in a previous edition of the book, financial planning used to be chapter 14, which made some sense because in order to understand the financial planning process, you first need to understand finance. So it made sense to go through several chapters before we talked about financial planning. When they moved to a newer edition, for some reason, they just crammed financial planning up into chapter 4, which is just not a very good place. So there's just actually 3 small items on your study guide that I will point out when we review for the test that you need to know from the financial planning part. The rest of it is going to be related to cash flows. Specifically, we're going to spend some time on the concept of depreciation because depreciation has an important role when it comes to cash flows. So, let's talk about depreciation for a minute. First of all, you've got a definition of depreciation listed here. You will see this on the first test, okay? It says depreciation is the allocation of the historic cost of an asset over time. Now, somebody explain that to me, please, in simple terms. What does that mean? The allocation of the historic cost of an asset over time. Over time, okay, long term. Okay, so he said every asset loses a percentage of its value over time. That's good. Okay, does anybody want to add to that? Or does anybody have a simpler definition of depreciation?
You buy a product and after using it for a couple of years, the price goes down. Like you buy a car, there's some miles on it, the price is going to go down.
Okay,
So
okay.
usually that's associated with the swing.
Okay, that's good. That's a good definition. Let me combine what both of these definitions in really simple terms. What this is saying is now this is for a corporation, okay, or for a business of some type. It can be a sole proprietorship. When you buy an asset, for example, a car, like you mentioned, the government, specifically the Internal Revenue Service, they assume that you get a certain percentage use of that asset each year that you own it. So if you buy a car, if you buy a computer, if you buy a printing press, if you buy a building, whatever, a tractor, a combine, a grain bin, whatever it might be, you get a certain percentage use of that asset each year. And the IRS, as we'll see in just a minute, they will essentially tell you what's called the depreciable life of that asset. So they will tell you how many years you can depreciate that asset over. For some assets, it might be 3 years, some assets 5 years, some 7 years, some 10, some go out to 30 years depreciation. Now, the reason for this and the reason that we really like depreciation is the second item mentioned here. Depreciation is what's called a non-cash expense. And what that means is when you take the depreciation expense on your income statement, so it will show up there, depreciation expense, the cash doesn't actually leave your company's bank account. So we love, as business people, we love non-cash expenses. Now, if you have a cash expense, for example, when you pay your company's electric bill each month, that's a cash expense. Cash goes from your checking account to the electric company's account. Or when you pay your employees, that's a cash expense. Cash goes from your account to them. But a non-cash expense means we can reduce our taxable income. Again, think back to chapter 3 in the income statement, so this will fall under expenses. We can reduce our taxable income, but the cash doesn't actually leave our company. So we love depreciation and any other non-cash expenses. Now, for tax purposes and for purposes of this class, we're going to use what's called the MACRS system for depreciation, MACRS. This stands for Modified Accelerated Cost Recovery System. Let me say that again. Modified Accelerated Cost Recovery System. And that's simply one type of depreciation. There are other types of depreciation, which I've got listed here. Got a question. So, what are some other depreciation methods that could be used? Straight line depreciation. Good. What else? Sum of the year's digits method. Okay, good. What else? This is where my accounting students, they shine through on this question. What else? Oh, come on now. Just two. You've got to know more than that. Accountants love depreciation. What about, let's see, have we talked about the double declining balance method? We haven't discussed that? Okay, that's a good one. That's always fun. Any others? I mean, there's a few others, but you're going to get the idea. There are other methods of depreciation besides MACRS, but we're going to be using this for tax purposes, and you can use other types of depreciation for other financial statements. So a company doesn't just have to have one set of financial statements. And that doesn't mean it's illegal. For example, you might have one set of financial statements for tax purposes, and you want to show as little income as possible because you want to pay the least amount of taxes. You might have another set of financial statements using another depreciation method that shows your income as large as possible because you want your stockholders to see that. So again, it's not illegal to have more than one set of financial statements. And then it says here that a shorter depreciable life is preferred to a longer life. Why is that? So if I buy a $200,000 tractor for my farm, if possible, would I want to depreciate that over 2 years? Or would I prefer to depreciate that over 10 years? And I'm depreciating the full $200,000. 2 years, okay? And the reason is I get to take a larger depreciation expense because remember, it's a non-cash expense. So I'm trying to reduce my taxable income as much as possible, so I prefer a shorter depreciable life to a longer depreciable life if I have the choice. Okay, now this is, you'll see this on the first test also, depreciable value. This is a formula, so you will have this given to you on your formula sheet. But what this says is the depreciable value of an asset is equal to more than just the cost of the asset. It's equal to the cost plus delivery plus installation. And a couple of points here. One says delivery and installation can be a significant amount. And that's good for us as a business because we want to be able to depreciate as much as possible. Now let me give you an example of this. I mean, some items are pretty simple. You know, you buy a computer, other than maybe some installation expenses for somebody. I mean, that's not really a big deal. But let's say that you're going to buy 20 of these big wind turbines like you see out west to create energy. Now, you've seen these things, okay? They're huge. And some seeing going down one of the local interstates here, one of the blades, typically they have 3 blades, some 4, but one of the blades, and it's on this huge truck. It stretches from here halfway across the quad. Can you imagine how much the delivery expense is on just one of those wind turbines? 3 blades and then the body? tens of thousands of dollars. So if you're going to put up 20, the delivery expense is going to be massive. So you're really glad that you can depreciate not just the cost of it, but the delivery expenses and any installation, because it costs a lot of money to put those up. So that's an example of depreciable value. Now, when it comes to the different depreciation periods or property classes, and again, you don't have to memorize this. I will tell you in the question, you know, it's being depreciated over 3 years, 5 years, 7 years, whatever. Now, it goes further than 10 years. I'm just showing you the first 4. For example, 3 years, research equipment, certain special tools. 5 years, if you buy computers, printers, copiers, a car for your business, a light-duty truck. 7 years, office furniture, fixtures, manufacturing equipment. If you happen to buy some railroad track, you depreciate over 7 years. And then 10 years, and you kind of get the idea. You can keep going down the list. But what that tells us is, essentially, the government says, if you buy a car for your business, you can depreciate it over a 5-year period. Now, does that mean that that car is useless after 5 years? Well, probably not. That car may still be a perfectly good car after 5 years. It's just that it's fully depreciated. So you don't get to take any additional depreciation expense. This is the reason that a lot of times at the end of the year, accountants will advise their clients that they need to purchase a new car, for example. Or if you're a farmer, a lot of times farmers are purchasing new equipment at the end of the year because they fully depreciated their old piece of equipment and they want the new depreciation. Now, this is one thing, and again, I'm not an accountant. Okay, I know a little bit about accounting, but I'm not a CPA. And again, you may own your own business one day, so you can kind of figure this out for yourself. But I don't really understand, for example, spending $1 on a new piece of equipment to save 30 cents in taxes, which is what you're doing. So if you've got a fully depreciated tractor and you go out and buy a new tractor, your one fully depreciated, go out and buy a new one, you're saving the depreciation expense, so you're reducing your taxable income, but you're still having to pay for that tractor. So you're saving 20 to 30 cents per dollar that you spend. So I kind of struggle with that sometimes in terms of what CPAs tell their clients to do. But again, I mean, they may have some other methods, but I've looked at this for 30 years, okay, and I still haven't quite figured out the reason behind it. Now, as a business owner, as a consultant, for example, I understand that if I have to buy a new laptop or a new printer or whatever, I mean, yeah, I love it because I get to depreciate that. And typically for small businesses, and I'll show you this in a minute, you can use something called a Schedule 179 deduction, which means you can fully depreciate the entire cost of an asset during the year that you purchase it, as long as you meet certain criteria. So for a small business person, that's fantastic. If you've got a lawn mowing business and you buy a new zero-turn mower for $6,000 this spring before you start mowing, you typically can deduct the entire cost of that mower this year. And that's going to save you a ton of money on taxes at the end of the year. That's exactly what they mean. When they talk about writing off an expense, in this case, we're writing off a depreciation expense, but you can also use that for any other expense too. Okay, so these are the property classes which you'll be given. These are the percentages depending on the property class that an asset would fit in. Now again, you see just the first 4 categories: 3 years, 5 years, 7 years, and 10 years. So what this tells us is, if we purchase an asset that fits in the 3-year category, it tells us that the first year we can deduct 33% of the depreciable value of that asset. The second year, we can deduct 45%. The third year, 15%. And then you'll notice, even though this says it's a 3-year depreciation schedule, we actually have a 4th period of depreciation. Now, you'll notice we have that for each of these. So the 3-year schedule has 4 periods of depreciation. The 5-year schedule has 6. The 7 has 8, and the 10-year depreciation schedule has 11. The reason for this is, and let's see if I've got it here. No, I don't. The Maker system uses something called the half-year convention. What that means is they're assuming that you're putting an asset into use in the middle of the year. So this depreciation schedule actually goes from July 1st of one year to June 30th of the next year. So the 3-year schedule, for example, would have 3 full years of depreciation. And what they're assuming, I mean, this kind of makes sense. They're assuming the first year you put something into use, you're going to put it into use, it's going to be pretty productive for you. So they're estimating you're going to use about 33% of the value of that asset. The second year, you've got all the kinks worked out, you've got it going full bore, whatever it is, and you get a lot of use out of that asset, so you deduct 45%. The third year, the asset's getting older, it's not as productive, it may have some breakdowns, it may need some maintenance cost, so you get 15% use. And then this 7%, this is the last little 6-month period that you're using this asset. So that's why you'll notice these last numbers for each of these are really small numbers. The asset's almost finished, at least according to the IRS. You're not getting much use out of it. They're just allowing you a small amount of deduction for the last 6 months because of the half-year convention. Now, in reality, again, these assets may be going strong after 3 years or 5 years or whatever. But again, this is just for depreciation's sake. And notice all of these percentages have to add up to 100%. Now, here's an example of calculating depreciation. You will have at least 1 or 2 of these on your first test. They're really simple because they give you the depreciation schedule. So you're going to see this table just like this on your test. Okay, so it'll have the first 4 classes. It's going to have the percentages. I'm going to tell you whether to use the 3, the 5, the 7, or the 10-year. So basically, all you have to do is calculate the depreciable value and then do the multiplication. So here's an example where we've got a company, Baker Corporation. They installed a $40,000 machine having a recovery period of 5 years. So this $40,000 includes cost, delivery, installation. Sometimes you have to add that. Here you don't. Now, notice the 5-year schedule, these percentages, the 20, 32, 19, 12, 12, and 5, notice it matches this 5-year schedule. So this is where these numbers come from. So the first year, we take the $40,000 multiplied by 20%. We can deduct $8,000 in depreciation expense for this particular asset. The second year, we take $40,000 multiplied by 32%, 0.32. We can take $12,800 in expense. And then it just shows you period 3, 4, 5, and 6, how much expense each year we can take. And notice when we add all of these together, it has to equal $40,000. Now, what happens a lot of times is what a lot of students, they want to take this $40,000, they get the first year depreciation, and then they want to subtract this from the depreciable value and then do the next year's multiplication. Okay, that is not correct. You're going to use $40,000 or whatever the depreciable value is each year for your calculations so that you come up with $40,000. Now, you'll notice we're simplifying some things in here. For example, we're leaving out something like salvage value. For the accountants in here, when you calculate depreciation, typically an asset's going to have some type of salvage value. That's what it's worth at the end of its depreciable life. Well, here we're simplifying it some, so there is no salvage value. Okay, we're simply saying this asset is worth nothing when we're finished using it. But is this fairly simple? I mean, everybody, if you see something like this, you can calculate this on the test. Understand where all the numbers are coming from? All right. Well, let's see if you do. So here's an example I want you to take just a couple minutes and work through. And I'll switch back to the percentages in just a minute. It says your company purchases a new piece of equipment for $20,000. Delivery costs are $2,000 and installation costs are $3,000. The piece of equipment has a 5-year depreciable life. Calculate the annual depreciation expense using the depreciation table. Okay, so we've got, first of all, the information here. It costs $20,000, delivery is $2,000, installation is $3,000. So what is going to be the total depreciable value of this asset that we use? $25,000. Okay, the 20 plus the 2 plus the 3, 25,000. So that's what we would put here in this column of cost. Now it says we're going to depreciate it over a 5-year depreciable life, so I'm going to go back to the table here. I'll just leave that up for you to do your calculation. You'll see you're at 20% the first year, 32, 19, 12, 12, and 5. And so take just a couple minutes, if you would, work through this just to make sure that everybody is good on understanding how to calculate depreciation. And if you have any questions about anything, raise your hand. I'll be happy to help. You actually, yes, you actually do need that. So you're going to actually have 6 calculations here based on this $25,000 asset. Because now what you're doing is you're trying to come up with $25,000 worth of depreciation, okay, over the life of the asset. So you'll notice each of these percentages, if you added them up, it's equal to 100%. So that's why you're just going to take a portion, a percentage of the 100% the first year. So you'll take 32% the first, or 20% the first year, and then 32% the second year, then 19%. And so each of those, and you'll notice as the asset gets older, you're taking a smaller depreciation expense, and that's because we assume the asset is less productive as it gets older. Okay. Yes. That's the cost plus, now that one doesn't have delivery and installation associated with it. But if it did, you would add all that together, and whatever that equals, you would do it just like we did here. You're paying for the item. You typically either are making payments on the item or you've already paid for the item. But this depreciation expense simply allows you to take advantage of buying that item. It reduces your taxable income because that's an expense. But the IRS says you can't expense, typically, you can't expense the entire cost during the first year.
Like, so like saying if you bought that for $25,000,
sell it for whatever you wanted to, okay? Now, on the balance sheet, it would show up that it was worth $20,000 after the first year. So the book value would be $20,000. But if somebody comes along and offers you $30,000 for it, if you want to sell it, you can, but the difference between what you sell it for and its book value is called a capital gain, and you have to pay taxes on that. All right, so let's take a look at this really quickly. 5 years, a $25,000 item. Let's see if I was smart enough. Okay, I wasn't, to work that out in advance, so let me do that here. Okay, so if we're going to depreciate this, the depreciable value, we said, was the 20,000 plus the 2,000 plus the 3,000. So the depreciable value is $25,000, or whatever this might be. And it's pretty simple. Now notice, for test purposes, since this is a multiple choice test, you know, I'm not going to ask you to calculate, for example, an entire problem like this. But what I might ask is something like, I might give you the information and say, what was the depreciation on this asset during year 2? So again, you have to know how to calculate it all, but you may just have to calculate a part of it, okay? So for this particular asset, it was 25,000. So we're going to use this amount for each year. So we're just going to carry it down here. And then we would just multiply it by the appropriate percentages. So this would be 5,000 in depreciation the first year. So this is our year. The second year would be 25,000 times, I think it was 32%. So that's going to be 75. That's going to be 8,000, I think. Is that right? Okay. The third year was 19%. Is that right? So 0.19. And so that's going to equal, let's see, 547.50. The fourth year times 12%. So that's going to equal 3,000. Is that right? 3,000. The fifth year, 0.12, 3,000. And the sixth year, the last half year of the half year convention, is how much? 5%. So that would be 1,250. All right, all those numbers correct? All right. And so this should equal, if you add that, it should equal $25,000, which matches the depreciable value of the asset. Those two should match. But again, for test purposes, I might give you this and say, hey, what was depreciation during year 3? So you'd have to know how to calculate. You go here, and you come up with 47.50. Or what was the depreciation during year 5? And you have to go through and calculate the 3,000, something like that. But is everybody, you comfortable with this? Pretty simple, straightforward. And the reason that we talk about depreciation and we spend some time on it in finance is because what we're trying to do is we're trying to maximize our cash flows. Okay, that's a really important part of this. And so as we're looking at this and as we're going through the calculations, and this is what I mentioned earlier, which I'll talk about in a minute, but let me jump ahead here really quickly. Okay. When it comes to cash flow, there's a couple different definitions of cash flow. One is called the accounting definition. The other is called, it's on the next slide, it's called the finance definition. So let's take a look at each one of these. Cash flow, as we mentioned back in chapter 1, that's what a company uses to invest. That's what a company uses to pay their employees. That's what a company uses to pay their utility bills. So you have to have that cash. And for the accounting definition, we calculate cash flow as net profit after taxes, which is the last line of our income statement that we looked at back in chapter 3. But we add to that any non-cash expenses. And typically, depreciation for a lot of companies is the only non-cash expense. So that's why I just have depreciation listed here. But now somebody remind me, to calculate cash flow, why do we add back depreciation to, this stands for net profit after taxes? That's exactly right. Remember, back in slide 2 or 3, we said depreciation is a non-cash expense. And that's important to us in finance because way back up the income statement, we subtracted depreciation expense. For example, when I brought up when we did this example here, the first year we subtracted $5,000 in depreciation expense. So that reduced our taxes that we had to pay. It also reduced our net income. But if we wanted to take a look at the true cash flow that we created during that year, we're going to take our net profit after taxes, our bottom line of our income statement, and we're going to add back that $5,000 that we subtracted earlier because that cash didn't actually leave our company, and we're trying to calculate the cash flow that we created, all the cash that we made. So this is a big thing for us in terms of depreciation. This is why we like depreciation. One is it's a non-cash expense, so it reduces the taxes that we paid. And by the way, back in the tax chapter, we kind of just reviewed that, but I did post a integrity video on that from a previous semester. When it comes to taxes, there are two terms that you need to be familiar with as a business person. One is called tax avoidance. And tax avoidance simply means that as an individual or as a corporation, you're trying to minimize the taxes that you have to pay through any legal means possible. So to avoid taxes, there's nothing wrong with that. It's not un-American. It's not unpatriotic. You're trying to minimize your taxes. Everybody does it. For example, if you're filling out your individual income tax form right now, if you have a child, you can take a tax deduction for that child. It reduces the taxes that you have to pay. If you own a home and you pay interest on your home mortgage, you can deduct the interest that you pay on your home mortgage. And anybody who's entitled to that will take that deduction. I don't know many people who say, yeah, I know I've got 4 kids, but wow, we're struggling in the economy. I'm sure the government could use my money more than I could. So I'm not going to take those 4 kids as tax deductions. I feel it's more patriotic of me to pay more in taxes. Nobody says that. Okay? And that was I try not to get into political things. Okay? You'll notice I try to stay neutral on this. But back during the presidential election, there was a lot of news on Donald Trump not paying taxes. He doesn't pay taxes. He hasn't paid taxes in years, whatever. Well, the reason is, and they explained it, but most people have never sat through a finance class. We talked about something called a tax loss carry back and carry forward back in chapter 2, which means that if you have an operating loss in your business, then you can deduct that loss against your taxes back 2 years and up to 20 years. Now, the thing about that is you have to lose a hell of a lot of money to take that operating loss forward 10 years, 15 years, something like that. So it's not like it's just painless and people aren't paying taxes. If a business loses money, they can legally follow the tax laws and not pay taxes against that loss up to the point where they've zeroed that out. It's not illegal. But everybody wants to hear big corporations don't pay taxes. Well, the reason they're not paying taxes is because they had a really, really big loss of several $1 million sometime in the past, and they're simply using the tax laws for what they're worth. Same thing if you take your kids as a child, as a tax deduction. You're not being unpatriotic. You're not cheating. You're just using the laws that the IRS allows. If the IRS changes that law, then you won't be able to do it any longer. Now, that's tax avoidance, perfectly legal. The other term that you need to be familiar with is tax evasion. You need to know this. Tax avoidance is legal. Tax evasion is illegal. Okay? You will go to jail, possibly, for evading taxes. Now, evading taxes takes on a lot of different definitions. One is, we talked about the child deduction earlier. If you have one child and you claim you have 7 on your tax form because you want that larger deduction, that's tax evasion. If you don't have any kids and you try to claim your dog as a child, that's not allowed, okay? That's tax evasion. And this is more common, but if you have a job where you're paid in cash and you don't report those earnings as income, as a lot of people don't, okay? And I understand that, but I'm just saying, technically, that is tax evasion. And anything else that you can think of that does not follow the tax rules, that can be illegal. Now, of course, it depends on the severity. You may be fined if you're audited. You may have some penalties. But in certain cases, in severe cases, you will go to prison for tax evasion. So you need to know those two terms: tax avoidance, minimizing your tax burden, completely legal; tax evasion, illegal. So what we're doing here is we're avoiding taxes by taking the depreciation earlier, but then we're benefiting in terms of cash flow by adding the depreciation back. All right, so that's the accounting definition. Now this is the finance definition. And I want you to take a look at this, and then I can switch back to the previous slide. I want you to tell me the one thing that the finance definition includes that the accounting definition does not include. Now this says the cash flow is equal to EBIT, that stands for earnings before interest and taxes. We also called that operating income back in chapter 3, minus taxes, and then notice we add back the depreciation, just like we did with the accounting definition. So what? Okay, the taxes, but if we go back, I'm going to switch back over here. If we switch back to the accounting definition, then since this is net profit after taxes, taxes have already been taken out of this. But what is still in this definition that's not in this definition? Interest, okay? Notice this is earnings before interest and taxes. We subtract taxes. We add back depreciation, but we never took out interest. Whereas here with the accounting definition, interest has already been taken out. This is the bottom line of the income statement. So the only difference between the accounting definition and the finance definition is the finance definition leaves interest in, and the reason they do that is because they look at interest, borrowed money, what you pay on borrowed money, as a necessary part of doing business. You need to borrow money a lot of times to make money, so you have an interest expense. So as we're looking at this, again, one of these is not necessarily better than the other. They're both fine. It's just you need to be consistent. If you're using one of these for a company, you need to use the same method if you're comparing companies' cash flows. And the reason that cash flow is so important is because this is what your loan officer, if you're a business and you go to a bank to borrow money, this is what your loan officer is going to look at. They're going to take your net income for your business, then they're going to add back to that any depreciation to come up with the total cash that your business created, because then they're going to take that total cash and determine, can you make your loan payment that you're asking for, that you're applying for, based on the cash flow of your business. So very rarely do they look at net income. They look at the cash flow. Another reason for that is you can manipulate financial statements so that your net income is either very small, 0, or actually negative and still have a positive cash flow. That's the best of both worlds. If you've got a negative net income as a business, how much tax do you pay on negative net income or negative taxable income? None. You actually get we talked about earlier, you get a tax benefit from it, a tax loss carryback or carry forward. But you get the depreciation expense, and then if you add back the depreciation expense to your negative net income, a lot of times that pushes you into a positive cash flow situation. So you're not paying any taxes, but you have positive cash flow that you could show your loan officer, your stockholders, whoever. So it's not unusual for companies to have negative incomes. I mean, companies lose money all the time. It's just that's part of doing business. Some companies lose small amounts of money, others lose billions of dollars. And you may ask yourself, how do they stay in business if they lose $1 billion? Well, the only way they stay in business, a lot of them, is because of the tax loss carryback and carry forward that we talked about earlier. That helps them kind of smooth out the business cycles that you learn about in your economics classes. If we didn't have that, the first recession that hit, we'd lose half of our businesses. They shut down. And if they shut down, how much personal income tax are the workers making? None, because they're out of business. They're not working. They're unemployed. So the government says, allowing this depreciation, allowing the tax loss carryback and carry forward, and the current tax laws which we have, which I'm not a big fan of, but it's what we have to work with, that's all legal, and that's what they think is best for our economy, at least for now. All right, so different definitions of cash flow. And again, this talks about inflows and outflows of cash. You might want to just mark this and take a look at it later. So what causes cash to flow in? Decreases in an asset, net profit after taxes, the sale of stock. What forces cash to flow out of our company? An increase in any asset, because what this is saying is if we buy an asset, we're buying it with cash. So it's decreasing our cash. If we have a decrease in a liability, that's an inflow of cash. If we have a net loss, that's an outflow of cash. If we have a net loss, that's an outflow, etc. And then basically, this is the very last part of this. What I want you to know is simply this slide, okay, regarding cash planning or financial planning. It says the financial planning process begins with long-term financial plans, and then these long-term plans guide the formation of short-term plans to get to that point. Okay, so that's one thing. You'll see that on your study guide. The second item is the two key aspects of financial planning are cash planning and profit planning. Cash planning involves the preparation of the firm's cash budget. This is extremely important. You don't want to just start operating hoping you're going to have enough cash to make it throughout the year, because in some businesses, especially seasonal businesses, you might hit some months where you have almost no cash coming in, but you still have bills to pay. So you want to budget that out to make sure you can smooth that out, or you have some way to come up with cash during those lean months. And also, profit planning involves the preparation of pro forma financial statements. What is a pro forma financial statement? What does that mean? Okay, it's just a forecast. Okay, so a pro forma financial statement is just a forecast financial statement for next year or 2 years from now or 5 years from now. That's what profit planning involves, forecasting these income statements and balance sheets. And that is chapter 4. So are there any questions about chapter 4? Before we move on Tuesday, we're going to move into chapter 5. Again, really, really important chapter. So try to have your financial calculator. Now, I'll have 2 or 3 of these that I'll bring to class. I typically try to bring to every class. But try to have your financial calculator, or borrow one, buy one. If you've got a scientific calculator, you can bring it and try it out, whatever. But try to have that on Tuesday. On Thursday, we will review for the test 1. And on Then the following Tuesday, we will have test 1. Remember, your quiz opens today, 2 o'clock. It's going to be open until Saturday at midnight. Everybody have a great weekend. Be safe, and I will see you back here on Tuesday.